finance does. More importantly, she's going to help engineer the presentation for all of you. She knows you're all primarily, contractors or proprietors, and all the information is relevant based on that.
Yeah.
Awesome.
Cool. I'm sorry that this is in lieu of booze.
There's a little clap here. Great. Can everyone see this here on an angle? Okay.
Cool. Yeah, so my name is Liz. I work for the New School of Finance. We're a fee-only financial planning firm, which the fee-only thing just means that all we do is give advice. Like, that's all we sell is our advice, and we teach financial literacy. We don't sell mortgages or credit cards or investments or anything like that, so we're always unbiased when we give advice. What you actually do with your money afterwards has nothing to do with us. Like, we don't stand to benefit from it. Whereas a lot of times at other places or other financial advisors or the bank or whatever, they're also selling something. So people come to us to get unbiased financial advice. And today I'm going to talk pretty much completely about like how money works for when you're freelancing or when you're a contractor, because it can get a little messier, I know, than when you're just a full-time employee. So we are going to talk about a bunch of stuff. How your taxes work as a freelancer, how to reduce your taxes owing in a legit way, registering your business, GST, HST, and how not to piss off the tax man, which is important because they will come for you. Okay, so income taxes. When you're an employee, are any of you also an employee, like anywhere else? Like you've got like so lots of people that I see at my job are an employee and then they have a side hustle, or their full-time kind of thing is their self-employment, but they also have a part-time job just to kind of like balance all the things. So as you may know, when you're an employee, your employer pays you and they deduct a whole bunch of stuff from your paycheck before you get paid. Income taxes, CPP, which is Canada Pension Plan, employment insurance, maybe there's other things that come off like health benefits or whatever. Whereas that doesn't happen when you're a contractor. You just get paid money and nothing's been taken off for you. So every year when you file a tax return, the entire tax return is called the T1, and the T1 shows all the income that you've made from any number of sources, and that's the income that you'll have to pay tax on. So it could be from salary, it could be from pensions, or like you have investments that are generating income for you. I'm going to run an example where we look at someone who has a full-time job where they make about $42,000 a year, but that they also have like a side hustle. They do some self-employment work on the side. So net self-employment income is also included in your taxable income for the year. And that net self-employment income, to get to what that number is, your accountant or you, if you do your own taxes, fills out a whole form called the T2125. Basically how it works is, here's all the money I made as a self-employed person, all my revenue. Revenue is before any of your expenses, before tax that people pay you. So, of course, there are expenses, and I imagine you guys do in-home fitness training, right? So you're probably like driving around all the time to people's houses, you have a lot of mileage you can claim, maybe some meals, maybe some like equipment costs, that kind of thing. All those things are business expenses, and so if you calculated all those up, say in this example, total expenses $6,200 and change, so the profit was only $3,715. The profit is what you actually pay tax on. You don't pay tax on all like the total revenue of $10,000. So it's really important to know how to write off expenses and write off all the things that you can that are business expenses, so that you're not paying tax on money that you didn't actually get in your pocket because you had to spend it to run your business, right? So in this case, the total income would be that $3,715 plus the $42,201. $45,916 would be your total income for the year, and that's what you actually pay income taxes on. Just a little quick aside about tax brackets, because there's a lot of misunderstanding about how tax brackets in Canada work. I hear a lot of people say things like, I don't want to take on that extra job, or I don't actually want that raise because I'll end up with less in my pocket because I'll be bumped up into a higher tax bracket. That's not a thing. There are tax brackets, but they're just marginal. So what it means is if you go up into a higher tax bracket, you only pay more tax on the amount you're earning above that threshold. So for example, on the first $42,000 and change, you pay a combined Ontario and federal rate of 20.05%. If you make $45,000, it looks like you might think, oh, I'm going to pay 24.15%, I pay more tax. But you only pay that higher rate on the amount between $42,201 and $45,000. So So it's just like you will always, if you're paying tax, you're making money. It will always mean that if you're working more and you're earning more, that you get to keep more. It's just that, yes, though, as you get into the really high tax brackets, you will keep less on that amount than you would have in a lower bracket, right? Like when you get up to over $220,000 a year, you're paying more than 50% tax. And so that's a really high tax rate on anything above that. So sometimes, like, it does bump you up, but the important thing to note is that you still get a portion of that money. You'll never earn less in a higher bracket than you would in a lower bracket. So in that example that I was running, your taxable income from your job was $42,201, which would be tax owing of $84,6130. You get some tax credits, so the owing estimate down here in blue, $6,200. But if you were an employee, your company already took this off for you. So you don't have to worry about that. You just like get your T4 at the end of the year and you plunk in the numbers, or your accountant plunks in the numbers, and it's already been paid. If you're lucky, maybe you even overpaid and you get a refund or something. But if we add in the self-employment income, that $37.15, there's an extra bunch of tax owing there of $897.17. Nobody has taken that off from you. So that is what you need to worry about come tax time. And this is why we want to put away money for tax time. Because the scariest thing for a lot of people that I see about taxes when they're self-employed is knowing that that amount owing is coming and not having it. That can be very stressful. Nobody wants to be going into debt to pay taxes. Nobody wants to have the CRA hounding them. So my advice is always figure out kind of an estimate of what you think you tend to make in a year. Check kind of what bracket that would put you in. A really good estimator is the simpletax.ca/calculator. Their little estimator is great because it actually includes CPP contributions, which a lot of other calculators don't. When you are an employee, the CPP contributions that you have to make, everybody has to make them. Your employer pays half and you pay half, but when you're self-employed, you pay the whole amount. And so often people are estimating, oh, I'm going to owe 20% tax. And then there's this extra like $4,000 of CPP owing at the end of the year that is a bit of a shock. So I like the simple tax calculator because it will tell you an average, what you're looking for is your average tax rate, not your marginal one. So if it says average tax rate 24%, then every time money comes into you, you would say, I'm putting 24% in a savings account and I'm just going to pretend it doesn't exist. So that when tax time comes, great. If anything, you'll have more money than you need because you'll write off your business expenses, everything's all good, and then you'll have created your own little refund for you, rather than worrying about how to drum up that money come tax time. So figure out what a percentage is that makes sense, 20, 10, 30, depending how much you earn, from all your sources of income, not just self-employment, right? It's all going to get lumped together. The higher your income is, the more you should be saving. So if you start out the year and you're like, I think I'm going to make $40,000 this year, and you estimate it, and then 6 months into the year you're like, whoa, I've already made $40,000. Obviously, I'm going to make more. You want to keep on top of it and checking, like, is this going to put me into a higher bracket so that we don't get surprised? So step 2 is knowing what you can expense so that we can reduce your taxes owing and keeping receipts. You got to keep receipts or keep the log of mileage or whatever. We'll talk about that. And I know it can really hurt to pay taxes at the end of the year, but remember, it's like you're only paying them if you're making money, so it's a good thing. And the more taxes you owe, meaning you're like making more, and business is booming. So when you're figuring out what can I write off as a business expense, the big thing is that you need to learn to distinguish between what's a personal expense and what's a business expense. And I'm going to highlight later for you a few categories that the CRA loves to check on, because there's a few sort of red flags for them that they love to like, oh, let me really see whether that was a business expense or not. So the first question is, was this expense necessary for me to earn profit? So for example, if you're driving to a client's house and you have to drive there, all that mileage and the cost of your car is absolutely necessary for you to earn profit. How are you going to get to their house and do in-home training if you don't have a way to get there, right? Or you take the TTC, or you ride a bike, or whatever your means of transportation is, that's a legit business expense. Yes, great. Do I have proper records? So either you bought something and you have a receipt, or you can back up how many kilometers you drove to and from client houses. Yes or no? You do? Great. You just have to find the correct category, like what business expense category does it fall into. And expensive. Great. If the answer is no, I don't have records, a especially if they're not records you can go back and create. Like a mileage log, if you have a good memory and you see the same people all the time. I mean, obviously it's like a better habit to get into of doing it all the time, but something like that, if you can recreate it if necessary, sure. But if it's something like an original receipt, like you paid for something and you don't have that receipt, do not write it off, because if the CRA comes back to audit you and you don't have the receipt to prove that that was an expense, they will definitely disallow it. You will owe tax on the amount that you would have owed if you hadn't claimed that, plus interest, plus penalties. So it's like just not worth it. Get in the habit of saving all your receipts so that you don't have to like make that decision of should I take that risk? If you don't have it, don't expense it. If it was not necessary for you to earn profit, don't expense it. So sometimes figuring out which things you can and can't, like, is this necessary for me to earn profit? Like, I need this coffee to stay awake for my early morning client workout.
But it's at 5 a.m.
It's at 5 a.m. Like,
Right, Mateo?
maybe. But it's possible that a CRA agent would just be like, yeah, but you would have that coffee anyways. Like, that's not really business expense. Oh, but you are like meeting a client. Maybe you're meeting a potential like person who wants to get to know you first or something. I don't know how it works.
Or you bought it for your client.
You bought it for your client. Oh, I brought you a smoothie. Like, let's get going. 100% business expense, okay? So be careful. And meals, like food and drink, is one that is definitely a red flag, which we'll talk about, because so often there are things that we already do in our personal life, and so you really got to have a record as to why that was business expense. So business expenses over here, those are personal expenses. So here are some examples of business expense categories that the CRA has: advertising, meals and entertainment, insurance, office supplies, etc. If you pay someone to do your taxes, that's a business expense. All kinds of things. One, 100%, because you're a business. If it was just like you were an employee and you paid someone to do your taxes, no, because that was just like a choice you made. But as a business, that's like accounting. Yeah, totally. So some things. So these ones that I've highlighted in orange are ones that anecdotally tends to be red flags for the CRA. Things that very naturally overlap business and personal, so they often like to take a closer look. So meals and entertainment, like we were just talking about, did I need that lunch? Can I expense that or not? Sometimes it's a really, it's a hard one. Like, I think if you are out all day long, like, or out all night long, and you're going between client houses and doing different workouts, and you're like, I have to eat something because I'm exercising all night and like not be able to go home and cook, you could probably get away with it, but it's still tricky, right? Travel and motor vehicle expenses are probably big ones for you. So travel would be anything that's transportation within the city, like where you're going to and from all those houses. And for that, you really gotta, if you got audited, they would want to see how many kilometers did you drive or ride your bike or whatever. If it's car, the way that it works is, so this is motor vehicle expenses. Travel is really like if you TTC. Motor vehicle expenses, that's your car, not the cost of like buying a car, but the maintenance and gas and all that stuff. For that, you actually get to take, do most of you drive to houses? Yeah, okay. You keep everything that has to do with your car. You get an oil change. You get winter tires put on. All your gas receipts from the whole year. Any maintenance and repair, your insurance, your parking, for sure. Everything except parking gets bundled together. And let's say you're like, okay, it cost me like $2,000 in maintenance and repair and gas and whatever this year to run my car. Then what you have to do, every year at the beginning of the year, you're supposed to look at the mileage on January 1st of your car. And you write it down. And every year on New Year's Eve, you're going to trudge right out to your car and look at the mileage then. And you say, okay, I drove 10,000 kilometers in the year. And so what you're supposed to do is say, and 5,000 of those were for work, which you have to be able to prove. And then you would be able to write 50% of that $2,000 of car expenses off at tax time. So basically, it's everything that your car costs, and then a percentage based on how much you drive for work versus personal. So what you're supposed to do, like the old school ways, like people have a little logbook in their door, and every time you drive, you're like, 5 kilometers. Nobody does that. I don't think anybody ever did that. They're just like fudging them later when they get audited. I do believe that there are a whole bunch of apps that can help do this for you now, like track your mileage. So I would look into that. The other thing that I say is, many of you probably see clients weekly or more than once a week, and you're doing the same routes. I used to be a tutor, and I went to people's houses to tutor. I saw the same people on Tuesday and Thursday. I drove the same routes every time from this house to this house and this house to this house. I Google mapped it once to get the total kilometers, and then it would be like, on Tuesday I drive this many kilometers, and on Thursday I drive this many kilometers, and then you can just track how many times you do that, right? Like if there's holidays or days where something gets canceled, you wouldn't track it, but every other time you can say whatever, and then you would just have to say, write down the addresses that you drove if you ever got audited, but you would have a record there where you could say, this is how I know where I drove. That's probably a lot easier. If you're always driving to different places, it gets a little harder because it's like you have to kind of do it every time. Like maybe you're not writing it in the book in the door or whatever with your odometer, but Google Maps does help with that for sure. But just remember to keep everything that you pay for your car at all. If you take the TTC to things for work, keep those. Like even if it's just like an individual transfer, you're gonna write that off. If you cycle and you pay maintenance repair on your bike and you use that to get to and from clients, you can also write off a portion of that. Basically, any way that you have to get to and from all your business stuff, you can write that off. If you bought a car specifically because you got to drive around to client houses to do this job, then you can also write that off under something called capital cost allowance. So capital cost allowance is there for big purchases where you don't get to write the whole amount off in 1 year. Like you can't say, spend $15,000 on a car. I'm going to write that off against my whole income for this year, because the idea is, well, it should probably last you more than 1 year, ideally. So how it works is different things fall into different categories. You buy a car, it falls into class, I forget what it's called, but it's like 30%, I think, so you write 30% off of the cost in the first year. And then the next year you get to write off 30% of what's left, and so on. Parking, if you're paying for parking specifically because it's a work thing, you get to write that off 100%. It's not a portion.
But not tickets.
But not tickets, no. That's on you. Not tickets.
Not that I'm pointing any fingers here.
Yeah, not tickets.
Yeah, sorry, just go back to the TTC there.
Yeah.
You know the Presto cards, so they'd be useless then, would they? Because they're not actually...
So, it used to be yes, but I recently was looking on their site, and it looks like every year now you can get a download of all the trips that you took. And you can get a tax receipt so it used to be there was a public transit credit for like if you bought a monthly pass, and Presto wasn't allowed for that, even though you're obviously using it repeatedly. Now you can use it for that. Now the federal public transit pass credit is gone, actually. So that's kind of pointless. But you should be able to get, there's a record on their site of all trips that you take. So you might just have to print it off and highlight. I would think that would be an adequate record. CRA tends to be a little slow on the changing technology and official, yes, this is acceptable or not. But I would think that if it has a date, you can highlight it and compare that you were with the client that day, that would be fine. Yeah. But you'd have to get that printout or whatever. Home office. So if you spend time at home, planning workouts for your clients, the main idea is supposed to be that if you spend more than 50% of your time of your work at home, that you can write off home office expenses. I have no idea if that is the case for you guys or not. But that sort of works the same as car stuff. You get to total up all the kind of home office expenses. I pay for internet, and I pay for a landline, and a portion of my rent or my mortgage, all those kinds of costs. And then you get to write off a usually very small percentage that is determined to be amount of space and time that you're doing work in your home.
What do you think a safe range would be?
Really depends. So 2 things. If you have a room in your house that is just an office where you do your work, and you can close the door, literally it has to have a door that closes, and you don't go in there when you're not doing work, it's a self-contained room, then you can write off, then you don't have to count time. You can say, oh, it's 10% of my home space, and you can write off 10%, you have to actually know square footage, you can write off 10% of those home expenses. If it is not a self-enclosed room where you can shut the door, if it's just like, I work at my kitchen table or something like that, and then later I eat dinner there, you have to both measure the area and say, so ridiculous, okay. Measure the area, oh, it's 10% of my home space, and then you have to do this calculation like, I sit there for 4 hours a day doing work, 4 hours out of 24 hours, 5 days out of 7 days a week, and figure out what percentage of time you're working there. And then it's like the percentage of time of the percentage of space of the percentage of the house. So if it's not a self-enclosed space, I would say it often ends up being like 4% or something like that. It's kind of a small amount. Whereas if you have an actual room with a door, it can end up being a lot more. It's an annoying calculation to do, but it's still worth it if you do work at home because you can write off part of your home expenses and pay less tax, right?
I
But
swear I had a curtain there.
Yeah. Well, really, if they came to your house and I guess in theory there doesn't have to be a door, but it has to be an area that clearly isn't used for other aspects of your life, you know? Like if they come to your house and it's just like a 1-bedroom apartment, they're gonna be like, where's that self-contained office? And you're like, it's the bathroom. Yeah?
Is it a maximum as well? Like, is it only like 7
No
to 10%
such
or
thing as a
something?
maximum, but
You can't
so the
write off
CRA
like
doesn't
50%.
set hard limits for these things. It's always like, what is reasonable? And so, like, a lot of accountants will say, definitely don't go over 15% unless you could, like, really prove it. But, for example, I had a client who has a bike shop, and they own the building, and they live upstairs, and the bike shop is downstairs and, like, basement. And so it was 50% of the space or something for the business, and they were like, that seems like a really scary thing to do with the CRA. And I'm like, right, but if the CRA came to your house and saw this is full of bikes and this is an actual store, it would be fine. But I probably wouldn't go, like 15% even on that end is pretty high unless, like, if they were going to question that when they come to your space. Be careful about that. Yeah. So those are all kind of ones where the personal tends to overlap, right? Like home office, meals, travel, like you have to be careful that you're not like writing off your grocery store trips or your road trip summer vacation under vehicle expenses, because if you can't prove it later, then you'll be in trouble. But there's all these other costs too that you can write off. Okay, so registering your business. I often recommend this. So this is what's called, in Ontario, it's called a master business license. It literally is just like you get a number, it costs $60. It just like announces to the CRA, hello, I'm a business. You do not need it in order to be considered self-employed or to claim income or derive off expenses. Like, it is not required. But why I often suggest it can be good is, for one thing, it lends legitimacy to your business in the CRA's eyes. Shows them that you're actually trying to be a business, not just like this is a hobby. So I say that because sometimes when people are starting out, the first few years of a business, their expenses might be a lot more than what they actually make, right? And they run a loss. And if you run a loss and you have another source of work, for example, it actually reduces your taxes owing from your employment too. So what they will look at you running a loss for too long and say, are you sure you're not just like making sweaters for fun and you never were going to profit off of them? Whereas if you buy this license and you're like, I'm trying to be a business, it kind of lends a bit more legitimacy to it in their eyes. Also helps you lock down your start date. So you're like, I'm a business as of this date. Can help for writing off startup costs, like if you wanted to buy a bunch of gear or something like that. You needed a new laptop and you bought it 6 months ago, but now you get your master business license and you're like, I was ramping up. You can also open a bank account or run your business under another name. This is probably not necessarily super important to a lot of you if you're just kind of like, you're not really, I don't know if you have a lot of equipment or startup costs or anything like that. Probably you don't need a business banking account under a name other than your own. You're just a contractor, independent contractor. So this might not be super necessary, but if you ever have like another business where you want to start and have it be under a name, you can't run a business under a name other than your own legal name or open accounts under that name unless you have that master business license.
How much does it cost to register?
$60.
Oh,
Yes,
can you write it off?
you sure can. Yep, that is a business expense. Not the same as registering for GST, HST. Okay? You guys aren't HST exempt, are you? I don't think so. Personal
No.
fitness. Too bad.
Chiropractors are.
Yeah, you know what's really, there's a lot of weird health unfair overlaps, like social workers and psychologists and psychiatrists are all exempt, but psychotherapists are not, and so psychotherapists have to charge HST, and then they're like, well, nobody will come see us because we're more expensive, so then we have to reduce our price. It's like kind of a mess. There's a lot of inconsistency with who's exempt and who's not. So, GST, HST. This is a big one that's really confusing for a lot of people. Yeah.
I had a question for before.
Yeah.
Registering your business as yourself versus just registering your business
Yeah.
under a different name. Is there a different process to do that?
Just getting that master business license where you say, like, I want my business to be named Nielsen Fitness. You just get the master business license as Nielsen Fitness, and then you're like, and it's me who runs it, but you can actually, the business name becomes Nielsen Fitness rather than Paul Nielsen.
That's what I did, and then in time it became incorporated.
Yeah, like about the incorporation.
Yes.
Like, what is the process for that?
You have to have like a pretty big. Well, I'll let you answer it. You're the one who's
Yeah,
here.
You can ink anytime, but generally, I don't recommend it unless you're making a lot more money than you need for your life. So, like, if you're like, oh, I can live my whole life, like, save and pay my bills and have a fun life on a salary of $80,000 a year, and your business is bringing in $120,000 a year, you're like, wow, I've got all this extra money that I don't really need every year. And if it's personal income, $120,000, you're paying tax based on those tax brackets from before. If you incorporate, the business and you become two separate legal entities. So the business over here makes $120,000. You're an employee of the business. You pay yourself $80,000, and the rest, that $40,000 excess, stays in the corporation and pays a very low corporate tax rate, which just went down again to like 10%. So it can be really beneficial.
You don't forget accounting fees. And don't
Yeah, so
forget,
this
now
is
you're
why-
an employee, you're
No,
also
no.
getting hammered with tax.
That's right.
Yeah.
And so this is why I always say it doesn't make sense unless you have a big surplus. It's not like, oh, I've got an extra $3,000. No, you won't, because it costs like a lot of money to do all the bookkeeping and the tax return. A corporate tax return can cost like $3,500 a year. It's ridiculous. And there's a lot more record keeping, a lot more compliance rules. Most people find that they need to hire a bookkeeper to do all the expensing and all that stuff rather than do it themselves. So I usually say unless you're kind of in the, you have $10,000 to $20,000 more dollars a year than you need and then some, don't ink. But I hope you all get there. So, but yeah, it's not the same as, it's not like just getting master business license is not incorporating, and it's also not registering for HST. So GST, HST is sales tax. Are any of you registered for HST right now? Yes.
We still have a question. I'm sorry.
Yeah, yeah.
So
Oh, yeah.
if you incorporate
Yes.
and 1 year, like Mateo was saying, you have less expenses and you want to pay yourself $60,000.
Yep.
And then the year after you're like, okay, I'm buying, I don't know, a huge boat. So I want $160,000 out of the corporation. Are you just gonna pay more taxes on the money that you're taking from the corporation into your account?
Anything that goes from the corporate account to your personal account pays taxes. Sometimes you can categorize it as dividends rather than income. Like, I'm just paying out, I'm a shareholder of my company, this isn't my salary. You still, the thing is with that, you pay less tax personally. Like, if you pay yourself a dividend instead of salary, you don't owe as much tax on it on the personal side. But dividends are paid out after tax has already been paid on the corporation. So you pay corporate tax, and then you pay a lower tax over here. Usually, like, depending on your tax bracket, it's kind of like you're paying the same. If you're the only shareholder, you're kind of paying tax, so same total either way.
It's a wash.
It's a wash.
Yeah.
Like, negligible amounts of difference, like $100 or something like that. And if you pay yourself only in dividends, or you pay yourself mostly in dividends, you actually are not eligible for RSP contribution room or CPP. You don't pay CPP, which means that you're not going to get government pensions. So I've seen a lot of people who are like, I'm making a loophole, I'm just paying myself dividends, but it's not necessarily better, and you end up without this like government pension and that kind of thing. Yeah.
Is there any benefit to it liability-wise?
So there can be. The main liability difference is because it's like a different entity than you. If you rack up debts in the business over here, it's very hard for someone to sue you personally and say, like, I want to sue you for the amount of money in your savings account or your house. Like, your personal assets are very hard for to get to if there's a problem in the business or you have debts in the business. But anybody can still be sued for anything. And so
And they will be.
And they will.
Yeah.
Yeah. I usually say if we're like just for liability's sake, it's probably better to just and cheaper to get insurance than it is to ink. And even if you're inked, you usually get insurance. But it is true that it's hard for someone to come after your personal assets if you're incorporated, unless you've done something illegal. Oh, then they can really come for you no matter what. Yeah.
Where you're talking to all ethical,
Above
board
people.
people here.
Great. Okay, so GST, HST. It is a sales tax. It is totally separate from your income taxes. Everything we were talking about before about tax brackets, you will still pay that. GST, HST is
The government's money.
the government's money. Well, so is your income tax, I guess. But this was never going to be your money. Okay, so if you charge $100 for your services, 13% HST, your bills would look like $100 plus $13 HST, and you collect a total of $113. The $13 HST is the government's money. It is never yours. You are literally an unpaid tax collector. They're just like, can you collect that for us and give it to us later? It's not ever going to be yours. So always, always, always stash it in another account. Like if you are charging HST and collecting it, do not be tempted to spend it. Stick it in that savings account with the amount you're setting aside for your income taxes, and don't touch it, because come tax time, you will file an HST return and have to pay that HST, and then you'll file an income tax return and have to pay your income taxes. Put it away. It's not your money. So a lot of people want to know, what the heck, when do I register for HST?
Quick question.
Yeah.
Are you going to talk about the simplified version of filing?
Oh, yeah, sure.
Yeah, because that might be simpler than having to deduct everything. If you think it's pertinent to the group, I think
Yeah,
it could
so
be,
there's
especially
two
the
ways.
HST collectors.
We'll come back to that. So, first we'll talk about when you charge it, because a lot of people are like, I don't know when I'm supposed to start collecting that. The official definition is when worldwide income reaches $30,000 during 4 consecutive quarters, which means when any and all sold prop revenue before expenses, okay, before taxes, before expenses, what actually comes into you, could be from multiple businesses. If you're a contractor from Nielsen Fitness and you also have a self-employment hustle over here that's like completely unrelated, those two things combined, if it goes over 30,000 or hits 30,000 in any consecutive 12-month period, so it's not calendar year, it's not January to December the way income taxes is. If you make over 30,000 in revenue between March 1st and February 1st of the next year, you'd have to register, okay? So, say you have a yoga business, $15,000 a year, and you also do web development, where you brought in $20,000. Total income, or total revenue was $35,000. You get one HST number for all your businesses, even though they're completely unrelated, okay? So, you can't charge HST without being registered. You need a business number to charge and collect HST. So by default, when you register for HST, you get a master business license, like you get a business number. If you already have a master business license, then when you're registering for HST, you use that number to get your HST number. So, as an example, let's say, okay, here's January to December, you made $22,000 over the course of 2017, and you're like, sweet, I don't have to register for HST. Amazing balls. So then February to the end of January, you make $23,000. We keep going like this, right? Month to month. You have to look at any consecutive 12-month period. Okay, there we go. May 2017 through April 2018, you hit $30,000. You now have 30 days to register for HST and start charging and collecting it, okay? So, there you have to register in there. 30 days after the invoice that pushed you over. So if it's like April 15th, then you have until May 15th. May 15th, you have to start charging, okay? That becomes the effective date. So if not, if you don't catch it, you don't catch when you cross that $30,000, you could end up having the CRA come back to you and say, you were supposed to be charging HST from May 15th, It's now July 15th, and we'd like our HST on all that revenue, and it just comes out of your pocket. And it shouldn't come out of your pocket. It should be on top of what you charge. Like, you shouldn't be going, oh, now instead of making $100 an hour or whatever, I make 90 something or 80 something dollars an hour. It should be I make 100 and the government makes $13.
So where you're saying it's like you're speeding and you didn't know, it's, ignorance is not an excuse. So they'll still ding you.
They will. They will ding you. Yeah, ignorance will never work. Yes?
What about if you're a healthcare professional in the near future, for example? Because there's a few of us as, patient of us chiropractic, for example.
Exempt is different. Yeah, so if you are a healthcare professional that is an exempt, HST exempt, then that doesn't go towards your 30.
But if you're a chiropractor and you're doing personal training, and personal training is not exempt.
Correct. Yeah, you don't become exempt overall. Just the business, the business that's exempt is exempt. Okay. Does that make sense? Yeah. Okay. So here's an example of late registration. You made $3,000 a month in May and June. So you would have to remit the GST on $6,000 out of your pocket. They would just say, oh, you owe us whatever that is, $700 and something dollars. Sorry, I'm not good at head math. And that would just eat into your own income. Not good. So it's really important to kind of every month, at the every month end, look back 12 months and be like, what am I at? Am I at that threshold? Am I at that threshold? Before expenses from all businesses. So then what happens once you've registered and you have to start charging it, is if you're selling in Canada, you actually charge based on where you're selling your services to. Now, I imagine that for the most part, you're working in Ontario because you're doing like one-on-one in-person work, in which case you would charge the Ontario rate of 13%. What's interesting about HST is that you actually charge it based on the location of your client. So if you do like a Skype, I don't know if this is a thing, but if you do like a Skype session with someone, you're just like yelling through the thing. I don't know if you yell. That's my vision of personal training. Faster!
The megaphone.
Yeah, you're like on Skype and they're doing push-ups and you're like, 5 more, or whatever, and they're in Alberta, then you would actually charge the Alberta rate of 5%. So wherever they are, that's actually what you charge. Okay, where the service is delivered to.
Do people really do that?
Yeah.
Okay.
Yeah, well, I mean, we do, right? Because we do Skype meetings all the time with people. Like, we do financial planning Skype meetings.
Mm-hmm.
You can't charge them 13% if they live, like, if they saw that on their bill, they'd be like, what the heck, if they were paying attention, which a lot of people don't. But if you charge it, you have to give it to the government. So we do adjust, like, most people will adjust and say, oh, that person was Alberta, so we'll charge 5%, and that person was in Ontario, 13%.
Okay.
If they're out of the country, in the US, for example, you don't charge sales tax. Sales tax free because they don't live in Canada. Yeah.
And you remit it all to the same place federally, though?
Yeah.
You're not like, here,
All
you're
the
at the
same
Alberta office. And
No, all in the same place federally. One HST return. Oh my God, you don't have, that would be a nightmare.
Oh.
You don't have to file like an Alberta GST return. No. Okay, so there's two ways of calculating your HST when you have to do your return. There's the main way that most people I see do it, which is that you say, here's all the HST I've collected. Here's all my business expenses and all the HST I've paid on business expenses. So let's say you charge $10,000 of HST to your clients, and you paid $1,000 HST on all your business expenses throughout the year. You do like HST collected minus HST that you paid on expenses equals HST owed. So sometimes you can sort of reduce your HST that you owe the government at the end of the year. The other way, it's called simplified. It's much more complicated to understand, actually. But the simplified method is it's really only if you have very few business expenses. You don't get to write off any HST that you paid on business expenses, but you remit a slightly lower amount, like you charge a slightly lower amount across the board. Every single time, you don't track where people are, you don't track your HST on business expenses, you don't get to write that off. And then you just say, here's all my revenue, here's how much that percentage is of the simplified method, and you remit that, no other calculations.
To pipe in, one of the things, if you do have low expenses overall, it's generally a good thing to do because there'll be more money in your hands at the end of the day.
Yeah, so it's worth like looking and seeing maybe over the first few years that you're kind of doing this. Some of you might be already a few years in, and you can look back at what it's been like over the past few years and say, how much do I have in business expenses? If you have business expenses, quite a lot, then the simplified method would not be good for you. You'd probably owe more HST than you would if you got to deduct the HST you paid. So, and specifically, if you have a lot of business expenses that you would pay HST on, right? Because it's not just that they take their business expenses; it has to be HST paid on business expenses. So, if all your expenses are things that are, say, HST exempt, like you're like, I need a massage, or like whatever. I don't know, legit business expense. But I mean, if there's like a lot of stuff that you pay for as business expense, but that you don't have to pay HST on, then it might be worthwhile looking into the simplified method because you might owe less.
You actually might be making money by starting to charge HST. And knowing this business, your expenses are probably pretty low compared to somebody who needs to like have expensive tools and equipment and very expensive liability insurance. For you, it's just a couple $100s a year. So it may make sense.
What's the rate for the simplified?
Oh, pop quiz. I don't know it off the top of my head. You can Google it.
I don't know. It's like maybe, I don't know,
It's eight something.
yeah.
And 8 point blobbity blue.
So
Really?
you
So it's like-
basically keep 7% of all the HST you collect, which
Pretty.
is
I thought you were gonna say 12.
good. So
No,
you'd give
no, it's
yourself
a lot
a little
lower.
bonus of 6%. And I've had several trainers over the years do that, and they're like, well, Paul, thanks.
Yeah.
So,
yeah.
yep, and it's all within the CRA regulated ways.
Yeah, it's not.
above
It's like
board.
an allowed thing. Yeah.
Yeah,
Because they save on people having to look it over.
and then you don't have to
Yeah.
worry about like, was my apartment, what percentage was my office, and you don't have to worry about your kilometer log. Even if you have a Nielsen Fitness card, you still
Well,
don't worry
you
about it.
still will for your personal income
Yeah.
taxes.
Yeah,
That's the
those
thing,
are some
right?
different
But
things.
that's the thing. If you're looking at if your business expenses are like your home office, well, you might not be paying HST on a lot of that. You don't pay HST on your rent or your mortgage interest or whatever, right? You don't pay HST on, I don't know. There's lots of stuff you wouldn't pay HST on.
Yeah,
Public
you're
transit. If you like ride your bike or take public transit to your client meetings, like even if you had some bike repair and stuff, there's probably very, very minimal like HST that you would be able to write off. So it's worth thinking about. The main thing would be gas. Like if you have a lot of gas expenses, it would be worth looking because HST is embedded in the price of gas, so you can get like a calculation of how much of HST that was. That would be the only thing that might be a high drive up your business expenses. So it's worth looking at. Okay. Don't piss off the tax man. I didn't make this slide. I'm not exactly a Lord of the Rings nerd, but yes, it's the all-seeing, all-night, knowing I'm Mordor. My boss Shannon originally made this, and she's very much a Lord of the Rings nerd. So yes, I am comparing the CRA to the Eye of Mordor. They can see everything, and I mean that like, if you get paid in cash, and then you put that. I'm not advising you to evade taxes. But if you get paid in cash and you're like, I'm not going to claim that as my income, but then you go to the bank and you put it in the bank, they can find you, they can see that. That's a paper trail. You put cash in the bank, they can look at your bank accounts and go, where did all this money come from that you're not claiming it was income, right? And so, so you have to be careful about like paper trails. I mean, the best way to save, so that's just an example of how they can really see everything if they want to. Don't lie about your income is my official advice. If you make...
And by the way, please say that again.
Don't lie
Because
about
there
your
are
income.
several times where the CRA contacts me, and we give them all the information of the income you earn as a Nielsen Fitness contractor. So if you are even off by like a little bit, they will audit you. And well, yeah, I've been audited, and it's not fun.
Yeah.
But it's much nicer experience when things are congruent.
If you have nothing to hide, an audit doesn't have to be super stressful. But it's true. It's not like, because there's layers here, right? Like, Paul is going to claim that he has paid you out as a subcontractor X amount of money. If then you say you didn't make that money, somebody's in trouble somewhere.
So they'll say, let's see the bank statements.
Yeah.
And it's a lot of fun getting that ready for them.
Uh-huh.
And then they'll be like, oh, it has gone. Okay. And believe me, it's not, you don't want to be stung from what I've seen. It's not fun.
And once you get, as you may have noticed, once you get audited once, they like to sometimes come back, even if you did everything right. And
They could audit an audit.
They audit an audit.
Yeah.
In general, once they've caught you on something once, they're more likely to come back and check on you like very frequently. which is stressful. Like, even when you're not lying, it's still stressful to gather up all your stuff and have the CRA person come to your house or whatever. So don't lie about your income. Okay, it's not worth it.
And just another word there, if you're
Yeah.
not sure how much you earned or billed Nielsen Fitness for 2017 and you just need a reminder, we have detailed records. So you just send a message to Monica and she'll give you the number.
That's really helpful because I know, especially if you're like thinking that you're getting close to that HST threshold, for example, and you're like, what did I make? Like, having someone who's kind of got your back that way is actually, it's a good thing. Be cautious of variances in your tax returns year over year. So as an example, let's say in 2016 you say, I have a home office that is 5% of my space, and you claim 5% of your home office expenses. Then the next year you claim 10%. The CRA is going to go, did you move? Did you take over more of your home? Like, what happened that made your home office double in size? Because if everything's the same, then they're just going to go, you're just trying to pay less taxes by like bumping up your stuff. They look back years and compare. So be really careful about those variances. It's better to be consistent. Keep good records. You need those receipts. You need those logs of kilometers, records of what you've been paid, all that stuff. If you get audited and they don't find that you've done anything wrong, like you paid all your taxes on time and the appropriate amount and all your expenses were legit, but your records were a nightmare, and you're like sifting through crumpled up things and they have to spend all this time with you to double check, you can still be fined for bad record keeping. Yep. Which I imagine is to compensate for the fact that they probably had to spend like 3 days with you and then didn't get anything out of it because you actually had done everything correctly. So keep really good records, super important.
Can I just say one little thing
Yeah.
too? A lot of people like cringe when they hear about the CRA, but every interaction I've had as a business, it's been pleasant, honestly.
Yeah.
They're really nice. And it's not scary. Like, they're super helpful. They're great
Yeah,
customer
and
service.
I have also heard there's just such a wide variance too, because it's
I've
like,
been lucky, I suppose.
yeah, no, I'm
Yeah.
sure lots of people are really nice. It's like you can get, but it's true that if you have an expense that you're like, this was business, one CRA agent might be like, yeah, I agree, and a different CRA agent might be like, no, I don't think so. So there is, like, a lot of the auditing is going to be up to the individual person that you gets assigned to you. A lot of them are really nice. I'm sure there's some assholes out there.
Yeah, for sure. I'm sure there is.
But all the more reason to keep those good records, right? Be reasonable about your expenses, yes.
And receipts, can they also have records from your debit and your credit card? Is that fair enough? Because I do have receipts, but putting them together, like they're all on my debit card.
Yeah, so technically I believe you need to have an itemized receipt that showed that you paid for it. It has to have certain information on it, and I'm not sure that they'll always accept. I think officially they would say, no, you need the actual original receipt. Sometimes I think you can get away with a credit card statement or a debit card statement if it has all the information that they need, but it's better to keep the original receipts.
Yeah, because it doesn't say what you bought on
It
it.
doesn't say what
It
you
just
bought,
says where
right?
you
It just
bought
says
it
where.
from.
There's an app that takes that you can take pictures of
Yeah.
your receipts. And it's like you're scanning them.
Yeah.
You can file them as you scan.
You don't have to keep the paper. You can have paper or digital. So you can take a photo and throw the receipt out, or you can, I also often recommend that people, if they take paper receipts, they just shove them in a folder, like this is my 2018 folder. You don't have to use that to track. I actually usually recommend that when people are doing their sort of bookkeeping, here's my expenses for the month or whatever, that they use a credit card statement or something, because it's just so much easier than dealing with piles of paper. I often suggest that people have like one credit card that they only use for business expenses, so that every month you can like download your statement and go log all my expenses, and I know they're all legit because I already made that decision when I was, like paying for my gas or paying for my car repair or paying for whatever, that was going to be a business expense. You just shove your receipts somewhere, but you don't have to use that for your actual bookkeeping, right? You can do a cleaner version where you have, here's all my statements when I'm actually writing things off. You still need to have receipts, whether they're a photo or a scanned copy or paper. Don't run a loss for too long. Like I said, if you're running a loss in your business, anecdotally, they'll probably let it slide for about 2 years, and then if you try to do it again in a third year, they'll be like, no, you're not a business, you have a hobby. You don't get to write off these expenses anymore. Just save for taxes, file on time, pay on time. It's kind of as simple as that. Be grown up. And remember that you're only paying tax if you're making money, right? So that's kind of all the slides I have, but I'm happy to take more questions. Yeah.
I actually had a point, point to make. I have a couple of friends who have been contract trainers
Yes.
for many, many years,
Yes.
and worked creatively to fudge some numbers or not claim some things,
Yeah.
which was save them at tax time, but now they want to get a mortgage.
Oh yeah. Okay. Yes. Thank
Right?
you for bringing that up.
Yeah.
So when you're self-employed or you're an independent contractor and you go to show you want to qualify for a mortgage, you have to show proof of income. And because you don't get a T4 or whatever, what you give to the bank or to your mortgage broker is that you have to see your notice of assessment from your taxes for at least 2 years. Your notice of assessment shows what your income was after all the expenses that you wrote off. So if you made $80,000, but you were like, I'm going to max my expenses, and so it looks like you only have an income of $20,000 a year, you will have a hard time getting a mortgage with an income that shows as $20,000 a year. And it doesn't matter whether you say, well, really, I make more than that, but I wrote some things that I weren't really business, like it was kind of whatever. No, they will go by that number. And so at the very least, you have to be careful of variances. So it's better to be reasonable and not write off too much to set yourself up well for the future. Some people will ease up on certain, if they're like, I plan to buy a home in a few years, they will be more moderate with what they write off for those few years so they can show a better income for a while. And if you do that, you just have to be really careful about where those variances now going to be a red flag to the CRA, right? That 1 year you wrote off a ton, the next year you wrote off very little. So you just have to be careful and reasonable, and yeah.
Do you have any resources you recommend to learn more about what you can write off? Expenses?
Sales pitch. We have an amazing online course called Soul Prep School that is like a bundle of 4 different courses that they're digital. So basically it's like downloadable Excel spreadsheets and videos that you watch to coach your way through the things. It gives you a spreadsheet for tracking your income and your expenses that's really easy to use. It gives you a form where you can kind of make a personal budget, and it says how much do you need to make to do all the things you want to do, and for vacations and stuff like that. And it also has things there's literally a video on every business expense category that the CRA has, and it's Shannon standing there for 5 minutes going, here's what falls under this category, here's how to calculate it, do not put this in this category, this is what goes in this category. So that's a really helpful kind of resource library for people. I'm sure I can offer a discount. I can give you guys a discount code in case any of you want to buy that course, which is also a business expense. Other than that,
That's great. Yeah.
Yeah.
That could be really helpful.
Other than that, good resources about business expenses.
CRA website?
Yeah, so the CRA website does have a page on business expenses. It's got them all listed, but you start there for sure. It's just written in language that is what now? I read it half the time and I'm what?
It's jargon. It's
It's very jargony. Are you
translated
pulling one
5
up
times.
as an example?
No, I remember years ago I bought a book called "Make Sure You Can Write It Off." I'm just seeing if it's still around.
That's very cool. Was it part of a program that had a name?
Usually for physicians,
Oh.
So to help you get everything set up and to know that you're doing it?
That's
properly?
really cool. I've never heard that before. That's
So
awesome.
I can see if they're still offering it.
Yeah.
Or, I think it was a pilot last year. So
Yeah.
it's still available.
That would be such an amazing program for them to do. People don't know.
And it's getting into
Even
the
they don't
habits of knowing
Yeah.
what to do, how to be aware of these things. Make sure
And
it's
they
above
don't
board.
teach this in school, right?
And
Which
then-
is the other.
And then can you talk a little bit about maybe investments if if at the end of the day any straight shooting, if you had to give 2 pieces of advice.
About investments?
Yeah. So say you have a sole proprietor,
Uh-huh.
say they're earning $40K a year and they manage to write off a certain amount and they get a refund check for $4,000 or
Yep.
something. And they're like, okay, I paid my accountant because I decided to have an accountant because then I knew I could write stuff off and how
Yeah.
much I could. And they say they have $4,000.
RSP.
What should they kind of do with
Yeah,
that?
what do you think would be a
Okay,
good
my
thing?
quick advice there, without delving into, because investments is such muddy waters. My first advice is that any money you might need to use in the next year to year and a half, you shouldn't invest. Don't buy stocks or mutual funds or whatever, because the market goes up and down. And if you don't have an emergency fund, and there's I'm sure there's slow months with personal training, and you're ooh, I need that money to help pay my bills. We don't want that to happen at a time where, oh crap, also investments have gone down and now I have to sell something at a loss just to pay my rent. So when you're investing money, think of it as like a minimum 1 year commitment or something like that. The other thing is to think about what kind of account you're going to put it in. So RSP versus TFSA versus just like a regular savings account. The RSP gets a lot of love, and a lot of people are like, you gotta start an RSP. And especially among self-employed people, I see like a lot of people wanting to put a ton in their RSP. When you put money in your RSP, it is deducted from your income, so you don't pay tax on it, which is very attractive, especially when you're self-employed and you actually have to pay the tax at the end of tax time. It's like, no, I have to put that in my RSP so that I don't owe tax. Great, but when you want to pull money out of your RSP, whether it's next year or when you're 80, when you're retired, whatever you pull out, you pay tax on it then. Okay, so if you're putting money in there and you might need to use it in the next short little while before you're retired, it shouldn't go into the RSP, because then if you're going to need it, you're going to pull it out, you're going to pay tax on it. Hopefully you're on an upward income trajectory, so you might pay more tax on it than you would have paid originally. And the other thing is, until you're making more than, I would say, $90,000 a year, like that you're paying tax on, you're not getting a good refund on that, good enough refund on that RSP to make it worthwhile even in retirement. Because when you're making under 90K, you're pretty much going to pay the same like tax percentage now as you would in retirement. But if you put money in your RSP and you invest it, hopefully it grows. So what that would mean is you put $5,000 in now, you get a refund of $2,000 or something like that. Great. But the $5,000 grows to $10,000, and then you pull it out in retirement and you pay more tax. You pay the same percentage. You pay $4,000 tax or something like that, right? And so it has to be worth it. The idea of the RSP is that you're in a really high tax bracket now, and you're going to be in a much lower tax bracket when you're retired. If you're making less than 90K, it's probably not worth it yet to do the RSP. You're better off using the TFSA. So the TFSA is amazing. You put money in, you don't get a tax refund now. It's like after-tax dollars that go into that account. But once it's in there, you can invest it or do whatever with it, and it grows tax-free, just like within the RSP. It's a tax shelter. So like any investment income or anything that you earn while it's in the TFSA doesn't affect your taxes. Then if you want to take money out of the TFSA, you can take everything out of there and you don't pay tax on it. Doesn't matter when you take it out. So if you put $5,000 in and it doubles to 10K and you pull out 10K, the $5,000 that you earn in the tax shelter, you never pay tax on. So the TFSA is truly amazing. I don't feel like it gets the respect it deserves, and it also is really great for a lot of the time, like unless you've got a really healthy emergency fund that could cover your butt if you had like a loss of work or just like a time. I mean, you're all self-employed in a fitness thing. Like if you broke your leg and you couldn't train for a while or something like that, how do we make ends meet, right? So you want to have either like good insurance, like long-term disability or critical illness insurance, but also an emergency fund to help pay for things if you have slow times or you can't work for a while or something like that. The TFSA provides like an extra buffer against that. Even if you're investing in there and something happens and you need that money, or you want to use it for a down payment in a few years, or you want to buy a boat, or I don't know, you can drain that account without tax consequences. So I prefer to see people actually try and max out their TFSA before they start doing the RSP. Kind of like get caught up on your TFSA room, and then if you're in a place where you're like, wow, I'm saving so much money, I can max out my TFSA every year and then some, then start looking at the RSP. Yeah.
EI.
Yes.
That's an opt-in, right?
It is an opt-in. When you're self-employed, EI is optional. To be honest, I very rarely recommend people opt in, but it totally depends on your situation. So you can opt in, but it's you can't get it if you just like are out of work. You can only get EI benefits when you're self-employed or like a contractor for a parental leave or for like an injury, sickness, or like compassionate care or whatever. It's not just like, oh, there's no demand for me anymore and I'm like laid off or something like that. You won't get EI. So once you opt into it as a self-employed person, you have to pay it forever and ever and ever till the end of your working life. So most people find it's like better to just like save for a parental leave, because it's a significant chunk. I think it's like 5% or something like that a year.
Up to $800, $900
bucks
roughly.
Up to $55,000 a year. So yeah, it's like you pay $900 a year. You'd probably sort of save a good amount of money to do like a parental leave or to have an emergency fund rather than opt into EI. Yeah.
That was a really great advice regarding the TFSA.
Yeah.
Yeah, because
I love
like
the
I
TFSA.
never knew that until like I looked into it.
Yeah.
And if you do some math, it's like holy smokes. Even
Oh,
if,
it's so
if you're only
cool.
saving 5 or 10% of what you earn at the end of the day, you do that for a few years, it can add up.
Hold on.
There's
Show
a
you an
second
example.
form super similar to it. It has like a little bit of higher interest, but you have to do it all on your own. It's like an online TFSA.
Did you intentionally do that?
I did intentionally, but I'm going to turn it back on
Yeah,
in
no
a second. I turned it off so that everybody can see all my blind spots.
That's cool. Yeah, let's post it up here. I'll get my pen handy.
It's an online TFSA
Yeah.
with
I
a higher
forgot the
interest
name
rate.
of it. It's called like, I deal with the corporation because I'm closer to that, but it's called like an online like savings account, and it's the same principle as the TFSA, but because you are doing it alone without a financial advisor, you get a higher interest rate because you're not using the.
So is it still
It's like
a
an
TFSA?
index
It's like an
fund?
online brokerage, like you can invest on your own?
It's still with the bank. They're just taking off the portion that you would have like gotten.
Is it invested? Like it's in like
It's like an index.
yeah,
Is it
it's
like a
probably
market?
like in index funds or ETFs or something like that. If you do kind of DIY investing and you open a brokerage account, you
No, it's still like under a normal bank.
so you can do those things under a normal bank, but are you saying it's cash or it's not invested? Is it invested or cash? Like would it be like, oh it's going up and down in value?
No.
Huh.
Just has a good interest
Just
rate,
as a really
maybe
good
savings.
interest rate or something, yeah. So I just want to show like an example. Okay, so 2018. Let's say you put $5,500 in, and then every year you put in $5,500, which is like the max. Let's say you were already maxed out in your 57. So your TFSA room is retroactive. So if you've never opened one, but you've been over the age of 18 since 2009 and a resident of Canada every year since 2009, you have all the room, even if you haven't used it. So the total room that you would have as of this year would be 57,500. Let's just imagine you're like, great, I'll put 57,000. Wouldn't that
Oh,
be nice?
good.
And then every year you get new room. Right now it's $5,500 a year. So let's say you were maxed out right now and you were like, I'm going to max out my TFSA every year. In 30 years, that would have grown to $533,000. And of that, this is just the interest earned. So I assumed it was invested at a 4% rate of return, which is pretty conservative. Of that 533, you see this? 305,000 of that was just interest earned that you never have paid tax on and never will. Like more than half of the money that you might end up with in a TFSA is like money you will never pay tax on. With an RSP, you pay tax on all of it eventually, right? When you actually withdraw it. So what's amazing with the TFSA is people often talk about it kind of like, it's a cute little account where you can like make a bit of interest or whatever. It's a great place to save and invest. It's a great place for retirement even, right? Like there's no one to say that you have to only use the RSP for retirement savings. It's actually really awesome. In retirement, like RSP withdrawals are taxable income, CPP is taxable income, old age security is taxable income. If that's all your savings is in RSP, you might find that you have a pretty high taxable income in retirement, and then they start clawing back on your government benefits, you're paying high tax. If you have this TFSA over here with $500,000 in it, you can just say, and I want $10,000 to go on a nice vacation. And like anything you pull from there doesn't affect your taxes. It's really awesome.
Do you think
I
they'll
think
keep it?
I think it would be a really
Not if the Liberals stay in power, I tell you.
Well, I wouldn't be surprised if they kept it. People would be furious if they. It would be such a.
I don't know. I should
I
have
don't
bit
know
my
either.
tongue there, and
It's okay.
I'm a little bit fiscally not liberal as
That's
much.
okay,
I
yeah.
think there should be great health care and great
Yep.
Services and daycares.
I don't think they'll
and,
increase the annual amount.
Mm-hmm.
Besides with inflation, for sure. I don't know. I don't know if they'll keep it.
We'll see.
I hope so because it's amazing. It's so much better.
They're gonna be like, we're losing all our money.
Yeah.
I've
Yeah.
heard they can stop it, but they can't.
They can't retroactively get rid of
Yeah,
it.
everyone that has opened one, ever since you've opened it, retroactively, even if you haven't been putting in
Yeah.
money,
You still
you're
get that
gonna be
space?
allowed to put that money.
Yeah, and I
Yeah.
think even if you hadn't opened it yet, you would always be eligible to like have that 2009 to
yeah.
2008 room or whatever. Like I don't think they could undo that. But I guess who knows? You can do anything.
So there's always like a risk it could go away. So if you can, take advantage of it.
Yeah, take advantage of it while you can. If things change, we cross that bridge when we come to it. But while it's there, it's absolutely amazing to make use of it. And I think it just doesn't get the love that it deserves because it hasn't been around that long, right? Like, my parents didn't have TFSA as part of their long-term savings thing, so advice is like, get an RRSP and start contributing to it while you're young. Really, the advice there is like, save for the future while you're young when you start working. That's good advice. It's just that it doesn't necessarily need to be the RSP anymore.
RSP has that mental thing where you feel like it's locked in.
It does, yes. Yeah.
And you get the tax refund.
Yeah,
It's
it's
a hard
like
psychological
I
barrier.
get it. You get that tax
Endorphins.
So
refund,
it's like
great.
a low-hanging fruit, but at the end of the day, you're going to pay a lot more.
Look, I can't tell you how many people, it's actually a staggering amount that I've seen who something has happened, like they're okay, but like they had a year where they were out of work for some reason, and they had no means to like cover their butt, and they now have like $50,000 of like credit card and line of credit debt because they really just had to like pay for life for a year. And now they're trying to get out of debt, and meanwhile they've got $100,000 sitting in an RSP. But to pull that out is going to result in huge tax things. Like, it's just so much better to first at least have a cushion of money that is accessible to you should something happen before locking away everything. Because it sucks so much to see that, and you're like, well, it doesn't really make sense. Now you're working again. We don't want to pull that money out now. It won't be worth it to pay down that debt. But now we're stuck with this figuring out this debt repeatedly. Have an emergency fund. TFSA is great for it. Start investing in the TFSA and then go from there.
That's great. 3 great bits of information there.
Any other questions?
Do you all feel like you've gained at least one little nugget of wisdom to help set yourself up for success? Because then it's all worth it, That was my goal here.
That's great.
And now you can all see each other by face and say hello. Now know each other.
Yeah, you guys must operate really just like
We're all very remote, yeah. Some we see more often, but.
I will email you a discount code that people could use if they wanted to do the Soul Prep School.
Oh, wonderful, yeah, and we'll pass that along. Thanks,
Yeah.
guys.
You might as well have it, no pressure, but it's there if you want to do it.
Yeah, if you're all kind of like do-it-yourselfers, that's a very good thing.
Yeah. It's a ton of information and it's totally at your own pace, which is nice. Especially when you're like, when do I have the headspace to
Think about
think about
taxes.
this?
Yeah. Well, why don't I start? Just give me a big clap here.
Thank you.